Don't know me, my name is Jason Harwood, CEO of Lifewealth. I want to welcome you all to our first web-based, Zoom-based investment seminar. Obviously, it's needs must at the moment. Obviously, for those in Victoria, we can't get together. We've got a couple of excellent presenters with us today, who I'll let James introduce. James has done a great job of bringing these two presenters together with us today. Today is very much a red letter day in Lifewealth. For those who may or may not have seen your emails as yet, we announced Paul McKernan, or Macca as he's affectionately known at Lifewealth for the last 20 odd years, is stepping back for an active role in Lifewealth at the end of November. So as I said, it's very much a red letter day, and I can say all of us in Lifewealth are just incredibly happy and incredibly excited for Paul and Jane, and the next stage of them moving to the warmer climate of Noosa. So it's very exciting. Given it is our first web-based investment seminar, our first webinar, we'd be really keen, as we always are from our Lifewealth clients, we'd be really keen to get some feedback from yourselves over the next week or so as to what worked well, perhaps what didn't work as well. We're really keen to make this as effective and as positive an outcome for yourselves into the future as well. So we'll shoot an email out the next week or so just to try and get some of that feedback. So we'd really appreciate that if you could provide that to us. Just a couple of practicalities today. If you do want to ask a question, please do. In the bottom in the bottom of the screen, you should see a Q&A button. If you click on that, you should be able to enter in your question, and our speakers, or James or myself, will be able to answer those questions as we go today. I'd also say, before we start, I also really would like to thank Jess for her work in pulling this all together over the last month or so. That is really much appreciated, Jess. We're really excited about what this brings today, and your work on this has been exemplary. Other than that, I think we can probably kick in. So I'm going to throw to Lifewealth's head of our investment committee, James Vandeloo, to introduce our speakers today. James?
Thanks very much, Jason, and welcome everybody. It's such an unusual phenomenon to be talking to you via Zoom, but that's the way of the world at the moment. So welcome. And to be honest, it's just really exciting to have a group of clients together again. So we actually miss you heaps, and we can't wait to get back into normal business, hopefully in the not too distant future. What an unbelievable year it's been. I did a review with a client this morning, and we had a look at their portfolio returns, which were modest, but actually positive. And I basically said at that time, if you had told me what's happened in the last year and said we would have generated a positive return, I probably wouldn't have believed you. So it has certainly been an amazing 12 months, and we've all lived through it. But what we thought we would do is get two speakers on today that come at financial markets and investing money from a slightly different perspective. Firstly, David, who's an economist, so looks at things from a macro perspective, but also sits on an investment committee and has a lot to do with designing portfolio construction and asset allocation. So a very high level view on what we might be doing with money and how he thinks the world looks. And then secondly, we've got Griffin, who's a portfolio manager who actually sits there and tries to actually pick stocks in the direction of markets in a short term, at sort of the pointy end of the portfolio construction process. So slightly different ways of coming about it, but both very, very important in helping us build portfolios. As Jason said, we'd love to get some questions along the way. If possible, I'll try and hold those back to give first David and then Nick an opportunity to say what they need to say, and then we can have some Q&A at the end. But please shoot them through, and we'll do our best to get to what we can. And if we have too many and we can't, we'll certainly go to David and Nick and try and get the questions answered for you, and come back to everyone who's attended and give them that feedback. So without further ado, I might throw over to David, who you should be able to see, who's sitting in the boardroom at Better Shares, I believe. As I mentioned, David is the chief economist at Better Shares. He's worked previously at Macquarie Bank. You may have read some of his work in the Financial Review. Welcome, David, and we'll throw to you and let's hear what you think.
Great to be with you, and thanks for the opportunity of talking today. Actually, James, before I begin, can I just clarify the time? Would you like me? My time is what, about 20 minutes?
Yeah, 20, 25 minutes, I think. Should.
Just yeah, okay. No worries. So, look, I'll just open my, share my screen and go through. So basically, yeah, I mean, as discussed, I mean, I sit on our investment committee here, and also as chief economist, and so I look at it from a very much a top-down, a global macros perspective, looking at global asset classes, and although you might at the sector level, but really a very high-level economic outlook in the asset classes. I'll break down my talk today really into these three elements, just some comments on the economic outlook, where we are in the COVID recession, so to speak, what that means for financial markets, how financial markets are currently placed, particularly the equity markets and the global equity market, and then just some thematics that arise out of that. But firstly, I'll start with this. Obviously, the story of this year has been obviously COVID sweeping itself around the world earlier this year. Governments uncertain of what they were facing, taking the lead from China and basically locking down their economies. The lockdowns of March and April caused the global economy to shudder to a halt. Equity markets, dived within a few months, so down 30-odd%. But then, the lockdowns did start to flatten the curve. The rate of cases, we did get gradual, then that allowed us to gradually reopen the economy, emerge out of lockdown, economic growth rebound, and equity markets rebound. Now, the long fear has been throughout the whole period of reopening that we would get second waves. The history of pandemics, going back to 1918, has been that you do tend to get second waves. So we had the Hong Kong flu and the Asian flu, also back in the 60s. In the 50s, and then the swine flu, particularly in the US. Each of those in their own way did have various waves, and so the risk has always been this year that we would get a second wave and potentially return to lockdowns. Now the big news, and that's why I've sort of got this up on the screen here, is that so far at least, knock on wood, we have had those second wave of viruses as feared, and so this is the Spanish situation. You can see the US is really, the rate of cases in the US is still remain at quite a high level. UK most notably, you could put other countries up there. But we haven't had the death rates, the pressure on hospitals to the same extent we had earlier this year. So what that means is that, yes, we've had second waves, but we haven't had the return to lockdowns. So that's allowed the economies to sort of continue to gradually recover. We've still got social distancing restrictions in place. But to me, this is the single, I guess, biggest development in the last couple of months as we've learned more about COVID. Now, having said that, France, has just announced that it's not gone back into lockdown. So lockdown is basically, the harshest is what we're seeing in Melbourne, the shelter in place, basically. Stay at home, don't leave unless you really have to. France has gone to a curfew from 9 o'clock starting on Saturday because a bit like we're seeing in the UK and Spain, the rate of cases has re-accelerated again, and they do fear unless they do something, then you could start to see a hiccup. But even in the case of France at the moment, importantly, it is not a return to the harsh lockdowns of earlier this year. So that's been a very important development. The other development, of course, has been that central banks have responded to this economic weakness by slashing interest rates. So before the COVID shock, the biggest problem in the world was inflation was a lot lower than the biggest problem for central banks at least was that inflation was lower than they would like, and even before COVID, interest rates were at incredibly low levels. Now with COVID, because they were trying to get inflation up, and they thought that was the way to do it. Now with COVID, they've slashed rates even further, so our rate has gone from, it's now down to 0.25%, in the US it's effectively the same level, close enough to be zero. But the other important development is that central banks are promising to keep rates on hold for a very long time. So not only have they cut rates, they're basically promising to keep rates near zero. At least, Phil Lowe today in a speech said that at the moment, based on the RBA's forecasts, the cash rate can stay where it is for 3 years, which is quite a long time. And as a result, bond yields around the world have sunk to very, very low levels. So that has helped support, obviously loan rates have come down, so it's helping support credit demand to some extent, but it's also obviously helped lift up equity valuations because low yields support high valuations in the equity market. Had a lot of fiscal stimulus, and just this first slide I think is important, just shows you the budget, the deficit. The countries around the world have really, supported their economies, increasing unemployment benefits, providing wage subsidies to keep people attached to their jobs, even if they're not really working. So just to see the cumulative net change in the budget deficit position this year compared to even the GFC 10 years ago, quite a big difference. And so we've had, quite incredible monetary stimulus and quite incredible fiscal stimulus. As a result, we have had a rebound in global economic activity or indicators. So the first slide there is the global PMI index, as it's called. It's a survey of manufacturing and services for most of the major regions around the world. And as you can see at the bottom, in February, March, when we had those lockdowns, this index basically collapsed. Far, far weaker than we had even in the GFC and the 2000, 2001 global downturn. But it has bounced back, and you can see the bounce back has been pretty broad-based around most major regions. Now, just because it is bounced back up to this sort of 50 zone, doesn't mean that activity is back to where we were. All that's saying is that on average, more companies today are seeing conditions better than they were in the previous month. That's what that index measures. But even so, as I'll show you in a minute, the level of activity is still well below where we were prior to the COVID crisis. And this is from aggregate weekly hours. So this is one of the issues with the labour market at the moment in many countries is that the level of employment, even the unemployment rate, is distorted by a lot of government programs. So that there's probably far more people unemployed than the employment numbers suggest, because people are being attached to their jobs, even though they're not really working because of the JobKeeper program. But similar sort of programs are in place in Europe as well. But one measure that can look at aggregate level of activities, aggregate weekly hours worked, and this just shows you the rate of decline of hours worked from their previous peaks. Looking at past recessions in the US and our downturns. And compare it with what we're seeing with COVID. And as you can see, what is remarkable with the downturn this year has been the sheer speed of the collapse. Within 2 months, we basically lost up to 20% of hours worked. And so the depth and the speed of that collapse compared to what we've seen in previous downturns. So it's a typical recession. You get a gradual weakening of economic activity. And it takes up to a year before the economy bottoms, and then it gradually recovers. And what I've got there is the blow up of just the last few months on the top slide at the bottom. This time around, basically the recession happened in terms of contraction of activity. It happened within 2 months. So April and March was when the contraction happened, and as you can see, aggregate hours worked has been gradually recovering ever since. So the good news is the worst is past. And we are recovering. The bad news is that even today, we're still, in terms of the decline in hours worked compared to where we were, we're still as bad as we were at the worst point of the GFC, something like 10 or so percent below our previous peak level. So there's a long way to go to get back to normal, but we are, knock on wood, no return to lockdowns, still in this recovery path. And that's what the equity market, for example, I think, sensed early, that this is going to be a very different type of recession. Typically, bear markets, equity bear markets associated with global recessions, last at the shortest bear market, i.e. a decline of more than 20% in, say, the US market during a recession. The shortest period has been 8 months up until this year. So it's usually taken at least 8 months, and typically around about a year before the equity markets bottom. And that's because the period of decline in the economy can last up to a year as well. Whereas this time, markets bottomed within a couple of months because the economy bottomed within a couple of months. So that's, I think, a big difference with the typical recessions that we've seen in the past. Just maybe to, for the interest of time, just to show you the situation with regard to Australia. So the unemployment, the Treasury had an effective unemployment measure, which basically covers people that have lost their jobs but aren't actively looking for work yet, and also people that are still, tied to their employer through JobKeeper payments but aren't actually working any hours. When you add all that together, you can see the unemployment rate in Australia actually at its peak hit around about 15% back in April, March, and it's since been aggressively coming down, now around 9%. And so basically the official unemployment rate, which today is around about 7% or so, is probably understating the degree of unemployment. But it's also understating the degree of improvement we've had. So unemployment spiked very high, but it's come down pretty nicely. But it's still obviously higher than where we were. The other big thing to keep a watch on in terms of the global markets, of course, is the vaccine. This will be a natural endpoint to the COVID, we hope, once the vaccine is readily available and widely distributed. And even if everybody doesn't take it, I mean, ideally you want everybody to take the vaccine, but even if a majority did, and that would help to build so-called herd immunity in the communities, then that would obviously then reduce the need to engage in tough social distancing restrictions. So vaccines are very important, and again, as this year's progressed, we've got more and more optimistic news on that. There's many trials going on around the world, and those trials are progressing through stage 1, stage 2, stage 3, and more and more experts. Nothing certain, of course, but more and more experts, expressing confidence that we should have a vaccine, or in fact, various versions of a vaccine by early mid next year. The budget is the federal government officially is budgeting for a vaccine to be available by the end of next year, but I suspect that's probably a little bit conservative. Just to, in the interest of time, just in terms of the financial markets, just to focus on the equity market here. This is the global equity market. As you can see, the grey areas here are the last 2 US recessions, and then we've had this short period here, which is a recession. I've sort of only put it, we don't know how long it will be officially defined as a recession, but either way, the recession began around about February, March this year. But just to show you the differences with previous recessions, so again, the global equity market took around about a year or so before it bottomed. And we had a big decline in earnings, as you would expect, particularly during the GFC, and we had an initial decline in price to earnings valuation. So not only did earnings fall, but the PE ratio of the markets fell as well, as investors feared further declines in earnings. So it's the combination of those two things that dragged down equity prices. This time around, earnings did fall, as you would expect, but the markets looked through that and have rebounded, as you can see there. So we've got a nice V-shaped rebound in the equity market. And as a result, price to earnings ratios have gone up. In fact, the highest levels now since the dot-com bubble 20 years ago. So you may hear reports of, valuations are very, very high, the dot-com bubble valuations. Now, 2 issues with that is, firstly, the markets, I think, largely correctly, increasingly so correctly, I think, are looking through this period of earnings weakness, and they see earnings likely to rebound as we head into 2021. So the P ratio can be elevated just because of they're looking through the depressed level of earnings. The second thing, of course, is that interest rates is just a lot lower, and I'll touch on this here. And what I've got there is the earnings yield of the market in orange. So that's the P ratio inverted. So if you invert it, you get through. So a P ratio of 20 is like an earnings yield of 5 for the market. And as you can see, the last time the earnings yield was around about these levels 20 years ago, the average global bond yield, so that's the yield of the global aggregate bond index, was around about 4%. So the equity risk, so the difference between the two, the sort of earnings or the risk premium for the equity market was around about 2% or so here. As you can see, going back to 99, 2000, whereas today it's still up around about 4%. Bottom line of that is that, yes, the PE ratio is back to levels we haven't seen in 20 years, but interest rates are a lot lower than what they were 20 years ago. So that's helping, push up valuations at the moment. And in fact, so I think you need to get used to the idea that PE ratios are going to stay at least in the high teens, if not in the low 20s, for a while, given interest rates are just so low. The earnings story, just to touch on, I've been watching this very closely in the last few months, and really the black line here is forward earnings, and what that is a weighted average measure of expected earnings that analysts expect for the current year and the next financial year. So it's like it evolves as expectations for earnings in the current year and the next year evolve. And basically, if earnings are expected to rise next year, forward earnings will start to rise as they basically approach the weight on next year's earnings increase in this calculation. What we've seen is that we did get a big decline in expected earnings earlier this year, but expectations for earnings have started to stabilise. And if that remains the case, the markets are currently counting on a big rebound in earnings next year. And if that remains the case, forward earnings will start to rise. And in fact, this is a quarterly number, but the monthly numbers are already showing some gradual increases in earnings. So again, that bodes well for equity markets next year. Low interest rates, recovery in the economy, and a recovery in earnings starting to come through. I guess the one and I'll maybe conclude on this, the one near-term risk is obviously the US election. The polls are showing that Biden has a big lead. Now, I guess the concern the thing about 4 years ago, we thought Hillary Clinton had a big lead and didn't win. So you need to take the polls with a grain of salt at the moment. One of the key differences between now and 4 years ago, though, is the level of undecided voters is a lot lower. So people are, saying at least a lot of the undecided votes last time ended up becoming Trump voters, whereas that margin is lower this time. So there's a little bit more confidence in the polls, but I still think you've got to take it with a grain of salt. But the biggest concern for the markets will be if it's a close result because of postal votes, and there's a lot of challenges about the validity of postal votes, and that's potentially a rerun of the 2000s. So I've got here share price performance leading up to and then in the weeks after both the 2000 and 2008 elections. So 2000, we had Bush versus Gore, where the result was uncertain, it was contested, it got dragged through the courts. Equity market wasn't too happy, and it sort of, as you can see, had a period of weakness. And 2008 was where the economy was already weak. It was wanting more stimulus, fiscal stimulus, and because of the election and because the new president, Obama, couldn't basically get through a new stimulus until he was sworn into office, we had delayed stimulus and the equity market weakened in that period after the election. It wasn't until the fiscal stimulus package came in early 2009 that the markets did finally bottom and start to rebound. So we do face a risk of either all those sort of scenarios. And but what I would say at the moment, the equity markets seem to be pretty comfortable with a Biden victory. And they're looking, and basically the markets are counting on a big fiscal stimulus package, no matter who wins, be it Trump or Biden in the aftermath. So, so provided that expectation holds, I think the equity market won't sell off too much at the moment because of that. But there is that risk of a contested result nonetheless, and that's the other risk factor we need to be mindful of. But the Senate's also important, and the polling at the moment does suggest the Democrats will win control of the Senate as well. But again, you need to take this polls with a grain of salt. And this is really, the positives and negatives of the election. If Biden wins and the Democrats win the Senate, there is concern that they will unwind some of the corporate tax cuts of Donald Trump and regulate the tech sector somewhat. Impose improved competition in the tech sector and the environmental regulations, these sort of things. But ultimately, I think markets learn to live with whoever is US president. So even if it's a blue sweep, so to speak, I think the markets you know, they may have a pullback next year as those fears materialise, but it certainly won't derail the recovery or derail the sort of broader recovery in the equity markets. I might just, in terms of asset allocation, just conclude on some of these points. I mean, growth versus defensive. I mean, I think to be fully invested in the market at this moment makes sense. So, you know, if whatever your strategic allocation to equities would be, my view would be to at least be at that allocation. View of the lingering concerns with COVID, the lingering concerns with the election, you probably don't want to be overweight at this point, but certainly being, you know, at a sort of a strategic weight would make sense. Within equities and within the markets themselves, I mean, I still favour global equity markets over the Australian one, and I think as we get through COVID, the technology sector globally, which has been a great outperformer, I think will continue to be a source of strength. And that doesn't really favour the Australian market. We have a tech sector that's a relatively small share of our market. So I think on that basis alone, I still see better growth opportunities as a bias outside of Australia vis-a-vis global markets. And just within the defensive parts of the market, lower for longer bond yields does favour picking up yield through longer duration bonds. Ultimately, there is a risk that when bond yields do back up, you're holding long duration bonds, their values will decline. But in the meantime, you're getting paid for that risk by nice yield pickup by holding bonds vis-a-vis cash. And so within defensive parts of one's portfolio, looking at bonds, looking at yield, basically any yield advantage you can get over cash makes sense. And another one, just to mention it, is hybrids. Hybrids are offering a good yield pickup over cash, and because that floating rate, you also then don't get the risk of a backup in bond yields. Hybrids sort of hold up pretty well. Look, I've hit 3 o'clock, so I think I might conclude on that and just pass it back to everybody else to have their turn. Let me just work out. There we go.
Thanks very much, David. We really appreciate those views. And if anybody's got any questions for David, please don't hesitate to shoot them through, and we'll have a look at them. The next speaker is Nick Griffin from Munro Partners. Nick would be familiar to many clients at Lifewealth. He's managed money on behalf of our clients for over 15 years through Munro Partners, his current business. He previously worked at K2 prior. It was all the way back prior to the GFC. He was managing money with us. Some of you might have remembered seeing Nick present in person a couple of years ago, and we did that briefing in Westpac's new building on Collins Street. And I remember at the time, Nick had some ideas, and he was talking about franchises and tech. And Tesla was one of the things he was bullish on at the time, and probably the rest of the market wasn't. And it's gone all right since then. And Nick, most of our clients are in Melbourne. I mean, we have clients everywhere, but probably the majority are in Melbourne. So we've had a pretty tough year with COVID down here, and we're stuck at home. You've made a lot of money this year. So does that mean you want to COVID every year, or can we all go outside and go back to normal?
Yeah, it's a good year. So you can hear me okay, James? Yes?
Gotcha.
And you can see the slide. Yeah, look, yes, we have had a good year. I've discovered if you lock all your staff in their house and don't let them go on holidays, it's good for performance as a fund manager. So I'm not sure I can keep them locked up forever, but it has been a good year for us.
Thank you. Well, I'll let you take it.
Yeah, so thanks, James. So thank you very much for dialing in. So I'm going to sort of move this conversation on to talk about stocks or global equities. I think David gave you a good summary of where the world's at and where COVID's at. So I won't really comment about that. On this presentation, I'll just show you, I mean, the reason why we have had, I suppose, a better year than most is we are a global equity manager. So we don't just look at Australia, we look at the whole world. In fact, we don't look at Australia at all. You have other managers who do that. We look at the whole world, and we're a global growth manager. So our job is to really identify structural change in the world and the resulting winning and losing stocks. And the reality is COVID is a big structural change for the world. It's created a bunch of winners and a bunch of losers, and in hindsight, I think they're fairly obvious. But at the time, you know, if you moved quickly, there was an opportunity, and we can talk a little bit about that today. We established the business in 2016. The flagship Munro Global Growth Fund, which I believe some of you are invested there at Lifewealth, has done a 17% per annum return since inception, and we run roughly $3 billion in assets under management, majority in our flagship global growth product. Look, just a very brief introduction to who we are and what we do. Look, all the team is based here in Melbourne, like the rest of us. So yeah, it has been a trying year, but we're proud of our Melbourne heritage. We run the business as a partnership. Everyone benefits from the profit share within the firm, and we have we're pushing up to 15 staff today, and we work really, really hard at basically traveling the world, or zooming the world more recently, to try and find these great growth companies that ultimately will complement the other things that James and Jason have you doing. Just flag very quickly, we do run, the main product we run here is this one on the left, which is the Munro Global Growth Fund. It is an absolute return product. So it's important to stress that this product has what we call downside protection tools. So instead of trying to beat an index, it's trying to create an outcome. And that outcome is superior risk-adjusted returns through the cycle. And so we say 10% per annum after all fees and expenses on a 3 to 5 year investment cycle. And happily, we have done that. We've done 17% per annum here and at Munro, and in our previous firm prior to that, we did more than 15% per annum. So we have a 15-year track record of doing over 10% per annum. And from that point of view, it's important to stress it doesn't happen every year. We are in equities. It is an over the cycle target, and so if you stick with us for 3 to 5 years, we're confident we can do it. We do have these downside protection tools, which I'll talk about a little bit in a second, but we can also just hold a bunch of cash. And so to show you how that fund would work versus maybe some of the other things you've invested in, this is just a good slide to show how the product works, was ultimately, like most fund managers in the world, we have an investment team that follows an investment process and does active research, as I just showed you, and picks stocks with high conviction. We happen to be a growth equity manager. Other people are value managers, or bond managers, or currency managers, or Australian equity managers. We are a global growth manager. But on top of that, just picking stocks, which we'll talk about in a second, we also have these bits in yellow, which is our ability to deal with things like COVID. So that's the ability to short sell both stocks and futures. The ability to hold up to 100% cash. Sometimes it's just helpful not to be invested. The ability to buy a put option on the market, or put options, that's been very helpful this year. And also the ability to, run stop losses or to manage your currency exposure. And those things really have helped us. The bits in yellow have helped us this year more than most. And so from that point of view, I'll show you the performance at the end, but ultimately, our fund is up more than 30% this year. It was up in the first quarter when the market was down nearly 20%. And it really was those bits in yellow that helped us. It wasn't like we picked a bunch of stocks that magically went up. We just managed to protect the portfolio in a difficult period and then invest for the future. And look, lastly, just a quick introduction on our philosophy before I show you where we think we're going to make money. It's important to flag what we mean by a growth manager. And so our philosophy is that earnings growth will drive stock prices. Sustained earnings growth is worth more than cyclical earnings growth, and the market always misprices growth and its sustainability. So what we're showing you here is two pictures just to really try and explain what we're trying to do every day. One is the Bank of America share price. The black line is its share price. The blue line is its 12-month forward rolling earnings per share expectation. David just showed you these for the market. I'm showing you them for the stock, blended forward. And the other one is MasterCard. That's the share price, and that's its 12-month forward rolling EPS. And so from our point of view, look, we just don't have a lot of value to add on where the Bank of America earnings are going to go. It's a macro-focused economic stock. So it relies on macroeconomics for its earnings to grow. And quite frankly, we just don't know where macroeconomics is going. Our view is as good as David's, which is as good as, or as good as someone else's. And so from that point of view, we don't really have an edge there. Where we do have an edge is over here. MasterCard is clearly benefiting from the shift from physical to digital cash. What's fascinating about this is that the market has known this for years, but is incapable of pricing it in. And the reason why it can't price it in is because it's accelerating. So this is what we would call a structural grower. This is a cyclical grower. We try to ignore cyclical growers because we don't know where the economy is going, and we focus really on structural growers. And our job is to really focus on that number 3 because the market always misprices that growth and its sustainability. Last just introduction slide, just to flag why we do this and why we may fit into your portfolio, is we just think it's all that really matters. The equity market is just a horribly misunderstood beast. People will often try and look at the equity market and, essentially attach an economic outlook to why this sector should be overweight or that sector should be underweight, etc. And we just think that's a total waste of time. The equity market is actually made up of very few winners, very few exceptional companies, and thousands of really average ones. And everybody on this call has had an experience with an exceptional company in Australia, whether it's a CSL or a Macquarie Bank or even a Woodside Petroleum back in the day. They are the exceptional few that make up the market. The problem is when you start, you don't know who those exceptional few are. And so this is just a good study that appeared in the Journal of Financial Economics, which basically told you, if you took every company that ever listed in the United States over the last 90 years, it ends up actually being 25,300 companies. And if you bought and held every single one of them, more than 60% of them, in fact, 14,000 of them go to zero. So more than half of every company that lists eventually goes broke. The next 8,000 only make enough to offset what the other 14,000 lose, and you end up with just 1,000 companies. So less than 4% of all statistical observations create the entire wealth of the US stock market over the last 90 years. And if you take the top 50 companies, which we've plotted here on the right, they make up nearly 50% of that entire wealth of the US stock markets. That's 50 companies out of 25,000 ultimately make up nearly 50% of the value created over a 90-year period. These are the exceptional few. We've plotted them for you on the right, showing you their analyzed return and how long they've been around. And we know who they are now. We know who they are because they are the few winners. And if you look at them, they're always driven by structural change, whether that's digitalization, which is the more recent structural change in our lifetimes, at Amazon, Facebook, Google, or whether it's software, which is the one before that, being Oracle and Microsoft, or big box retailing and Home Depot and Walmart, or quick service restaurants and McDonald's, or entertainment and Disney, all the way down to Coke and Pepsi. These were big changes that basically changed how we shopped, or how we used the internet, or how we used software, or even the products that we drank. But the reality is there's always the same thing that's going on. There's just these few winners and lots of losers. And so our job is, how are we going to find the next ones? What's this chart going to look like 5 years from now, 10 years from now? Who are the companies that are going to appear in the top right-hand corner? That's what we're trying to do. And COVID has just created a big structural change that suggests a whole bunch of new companies are going to appear here at some point. Just to lastly summarize how we think about that and what we're trying to do for you is we're really looking for these S-curve type opportunities. So these are structural changes as opposed to cyclical changes. And the biggest one that everyone knows is mobile phones. So this is the mobile phone market in 2008. This is the mobile phone market in 2018. And so you can see mobile phones don't actually grow. You used to sell 1.6 billion phones per annum. You now sell roughly 1.7 billion phones per annum. So people buy a new mobile phone pretty much once every 2.5 years. But along the way, we shifted from feature phones, which is the dark blue, to smartphones. Down here, Apple was a small nascent company, who decided to release something called an iPhone. It had a $50 billion market cap here. It has a $2 trillion market cap here. And basically they won the smartphone wars. They beat. And in the blue line are all the guys who disappeared, all your losers, so to speak, your mediocre companies, your Nokia, your Ericsson, your Motorola, your HTC, your BlackBerry, your Alcatel. I'm sure I could name some more. And the reality is most of the profits actually went to Apple. That's the structural shift you're trying to find, because that happens no matter what. It happens if Donald Trump gets elected. It happens if there's a European crisis. It happens if there's a financial crisis. Those are the structural shifts we're looking for, because that's how you're going to find these few winners. When we look at the world today, these are the big structural winners that we've been following for a long time, or the structural trends we've been following for a long time. So we're your global growth manager. We have to go find these big structural changes and the potential winners. The most obvious one I talked about at the top is the shift from cash to card. So as the world moves away from cash, here, this is the US at 35% cash, 65% card. It's now 60%. It obviously favours companies like PayPal, Visa, MasterCard. Obviously, you've seen things like Afterpay in Australia. It's the same for digital advertising. It's the same for cloud computing. It's the same for e-commerce. E-commerce has taken 20 years to go from 0% to 20% of all retail sales in the US. Now, the funny thing that COVID did, which basically has meant that this year's been a better year than normal, is that all of these things were growing slowly over time as consumers slowly adopted e-commerce or slowly adopted, tap and go around the world. And what COVID did is it just accelerated all of them. So it took you 20 years to get from 0 to 20% of retail sales in the US to be e-commerce. It took you 6 months to pick up another 7% of share. It's currently 27% today. So when you think about a company like Amazon, even though the retail sales pies got smaller, their share of the pies got dramatically bigger. And so we're having to upgrade our earnings estimates on Amazon, which means the share price is going higher. And if anything, when we look across this group, yes, they've all done well, but they're really just pricing in the pull forward of demand that's happened. And if anything, the demand will continue to be pulled forward the longer the crisis goes on. And yes, we agree the crisis will eventually go away, but and ultimately we will get back to some form of normal. But I think you'd all agree that a lot of these changes are now permanent. You've got used to using e-commerce, or you've got used to buying your groceries online, or you've got used to Zooming, or you've got used to not carrying cash. And yes, that's been the same in this country, but think about the other countries in the world where it hasn't. And so a lot of these changes are permanent. They've been pulled forward. And so ultimately these companies have done very well. We think they're going to continue to do very well. They are your few winners, if that makes sense. And I think as you go in through this results season, you really are going to start to see some quite staggering results from these companies. The unfortunate thing about this is they are taking share from smaller businesses, or they are helping smaller businesses pivot their business. And yes, more and more wealth is just accruing to these few companies. That will have consequences at some point. I'm just saying it won't have it today. And it probably won't have it for the next year or two either. But ultimately, our job is to find these companies and also to find the next ones. The other areas that we're acutely focused on at the moment, this is the global biological drug market. So we're obviously talking heavily about vaccines, about healthcare. Healthcare is actually our biggest bet in the fund today. And here we're just really looking at the companies that are going to help build the vaccine, that help test the populations, and that will ultimately sell the equipment that can prepare us for the next crisis. And these companies are not as well known, but I'll show you some in a second, and that's really the biggest bet in the fund today. And so again, looking for companies that are net better off because of COVID. If they're better off because of COVID, it means their earnings are going to grow, which means their share price is going to grow. The last area that we think is really starting to get going now is just the shift to a zero carbon economy. As an S-curve goes, this one's really right at the start. And so from that point of view, there is, for a long time, we've talked about carbon, reducing our carbon input. There's now a very, very strong pressure and a very strong momentum behind moving to zero carbon. So Europe has announced zero carbon by 2050. China's announced zero carbon by 2060. And that doesn't mean you stop emitting anything. It means you don't emit anything. And this is going to cost trillions and trillions of dollars. And so a lot of these companies are really right at the start of what we think is a really wonderful opportunity. So putting that together, these are the areas that we're focused on. These are the areas where we see strong structural growth in the years ahead. And this is, ultimately where we fit into your portfolio. And what you can see here is, innovative health makes up nearly 18% of the fund across 5 companies. Thermo Fisher happens to be the bigger, but we'd also include things like Danaher and others. And I'll talk a little bit about that in a second. Second area would be digital enterprise. So really, these are really cloud computing companies. So here we're looking at Microsoft, Atlassian, ServiceNow, Adobe, companies that you're using more and more every day as your business transforms digitally. E-commerce is Amazon and Alibaba in China. Digital payments we discussed. In the climate area, we have a few more names here, 6. They're mainly in Europe. They're things like Ørsted, which is the world's largest offshore wind turbine powered developer, or things like Vestas Wind System, that's an offshore wind OEM. And down the bottom here, these are really high performance computing is semiconductors, and connectivity is really things like Qualcomm and Charter, how you connect to 5G networks, how you connect to super fast broadband networks, really weapons enablers in the war that we're basically going into in technology. Look, in all of these areas, we think they're going to structurally grow. And we hope that these companies then grow with that area to grow their earnings, and their earnings will ultimately grow their share price, which will ultimately lead us towards our 10% per annum returns. That's sort of how we show it in the quarterlies, etc. When you get your monthly report from us, it looks more like this. So this just shows the same thing by regions. We are roughly 85% invested today, so we're fairly fully invested for our fund. We understand there are concerns out there, but we'd actually agree with David that the equity risk premium is actually still very high. A lot of our company's growth is actually accelerating. And so it probably seems a reasonably good place to invest at the moment. And while there are concerns, and we understand those concerns, most of them are reasonably well appreciated. There's not, you know, it's sort of that time after the car's already crashed where everyone's trying to look for what's going to go wrong next. The real downturn in markets happens when everyone's complacent. And no one's complacent right now, I can assure you. And so from that point of view, we do see the equity risk premium, and so we are reasonably fully invested here. But if you look at the bottom here, we do own a few put options for over the election, should we be wrong. Lastly, just from me on the performance of the fund, this is our performance over the last 4.5 years. And as I said, the goal of the product is to really try to achieve those double-digit returns per annum, which we've done. We've done that 16.9% per annum. And more importantly, we're doing it with a lower risk than the market. So the beta of 0.6 means you've got lower volatility than the market. And what's interesting about that is got lower volatility than the market, even though the stocks we buy have significantly higher volatility than the market. And that's just really a function of some of these things we do around capital protection to get through these difficult periods. And you know, I'll happily go into a little bit more detail on those in the Q&A. But what I might do there, James, is I will stop and check if there's anywhere else you wanted me to go.
No, I think that's terrific, Nick. I did have a couple of quick questions for you. We had one question come through asking about, obviously October is seasonally a weak month. Is that something you think about, or do you just think I'm holding really great businesses, so I don't care?
Probably more the latter. I mean, well, so far this October, we're up 5% for the month. So far it's been okay. But, you know, we're only halfway through it. I think people, as I said right at the start, get very caught up in the market. I just think the market is this beast that just goes up and down based on economic news. And yes, that happens in the short term. But over the medium term, what you're actually trying to do is find these great companies that can grow no matter what. And if you can find them, you know, you have to accept that there is going to be some volatility from month to month. You have to accept that this is the equity market. You know, if you want low volatility, you can go buy a bond. And with that bond, you'll get a 2% return. So if you do want the extra return, you have to accept a little bit of volatility. And what's important to really focus on is trying to find these companies that win no matter what. Because that will give you earnings growth, which will ultimately give you your share price growth. And yes, we do try to manage these bumps with things like put options and cash, but that's all we're really doing is managing the bumps. Ultimately, we're going to make our money by picking the right stocks.
Another one for you, Nick, is the way you build your portfolio with put options and so forth. It turned out that your cash weightings increased earlier in the year when volatility picked up. How hard do you find it to go back in? And now, as you said, you're nearly almost fully invested. You've generated good numbers. How difficult is that? Because that's one thing with clients we find difficult is, you know, getting out of markets because they're a bit nervous about getting back in. Is there a process around that?
There is. Let me just, I'm pulling up the slides as we speak, I promise. So you should see the slide I showed earlier around, you know, some of these downside protection tools and how they might work. So remember at the core, you're doing this stuff. That's how you make your money. And then you've got these things that are useful. How we think about this is really to focus on that capital preservation mindset. So when we invest, we're actually not trying to beat the market. We're just trying to make you 10% per annum after all fees and expenses on a 3 to 5 year view or better. And the key thing to do there is to not lose 25 or 30% in any one year, because you will never actually hit that number. It's mathematically impossible. And so that mindset around downside protection is really just about Generally, you don't see these things coming. The point is when they do come along, what can you do about it? What can you do to help protect clients' capital? And so this is just a good slide that sort of shows what we do. So this is the net exposure of the fund over the time. So, it's normally roughly 80% invested. We do have some short exposure down the bottom, so we are investing roughly 100%. But what you can see here is these big drawdowns in net exposure, both here in December 18, which is a period where the market fell nearly 14% that quarter in the US, and obviously here for COVID, where the market fell over 20%. Now, in both scenarios, we're not selling the whole portfolio. The whole portfolio we have, long-term views on. We might sell some stocks where our views change, like things like Airbus or Boeing went pretty quickly here, or maybe luxury goods. But ultimately, the whole portfolio should endure through most scenarios. So what we're actually doing is just hedging the fund, either short selling stocks, short selling futures, or buying things like put options that create big synthetic short positions. To show you how that works in pure attribution sense, this is the same two periods. So this is the December 18 period where the market actually fell 14%, and our longs fell 14%. So our portfolio didn't outperform. But we managed to short sells out at about 2%, put options out at just under 2%, and so our US dollars out at about 1.2%. And ultimately meant, we kept the drawdown to roughly 10% for markets. Here, the market actually fell more than 20%. Our portfolio did better, mainly, this is mainly a combination of being in the right places in the first place. So we obviously didn't see COVID coming, or, we knew it was out there, but we didn't think it would be anything like what it turned out to be. And I don't think we're, Robinson Crusoe there. But from that point of view, when the market did start to fall, we managed to obviously focus more on our digital companies and sell things like Airbus and our luxury goods. But also, short selling really added a lot more to returns, as did things like put options, as did currency. And ultimately, this ended up being a positive quarter for us, despite the fact that markets were strongly negative. And so I think the important thing to point out here, James, is, there is no guarantee that these tools are going to work for us. Every drawdown is different. Every situation is different. But we have a process, a stop loss process around how we use the tools. And we have a long track record of using them really well. And yes, this one worked out well. This one didn't work out as well, but we have them and everyone else doesn't. And so that should hopefully give clients some comfort that, that we've got their back when things get difficult.
Thanks, Nick. I've probably got one more for you and then a couple for David. The last one here is, it's pontificating a little on the future. What do you see as the next wave of information technology, i.e. HPC, automation, self-driving, next evolution of mobile? What's any thoughts there?
Yeah, we do. We do have one thing that I'll just show you really quickly. Sorry. Yeah, so I showed the slide earlier that basically pointed out that, that we've got to find the structural change that'll find you the next big winners. We happen to be living through the digital revolution. We're very lucky people. You imagine this pandemic without it. We're very lucky that this has happened. It's important to stress that the digital revolution's actually been driven by accelerating compute power. So people sort of think the disruption's going to slow, and I just think that's fanciful. It's clearly going to accelerate because it accelerates because computers get faster. Moore's law, back in the 1970s, you could fit 2,000 transistors on a semiconductor chip. You can now fit 54 billion. Computers double in speed every year, and it's an exponential. So it goes 2, 4, 8, 16, 32, 64, all the way to 54 billion. We know that these computers will keep getting faster. Moore's law has at least another 5 to 10 years to go. What everyone misses is what that does for value. So if you think about the internet, it's just a big computer. It used to be able to just send an email, but then it can do search, and Google comes along and pretty much wipes out every single yellow pages on the planet and consolidates all of that value in one company. And then the internet gets on your phone, and that creates Apple. That's another $2 trillion. Then you can send pictures. That creates Facebook. That's another $1 trillion in social networks. Then you basically get to e-commerce, digital payments. Then computers get fast enough because of Moore's law to stream video, and along comes Netflix and some of these other things. And then we have obviously the video games that become interactive. The part of this curve that's really most exciting right now is where we are here, this one here, software. We're at a period where software is just effectively eating the world, and where everybody is just discovering, that software can save you money. So my national roadshow used to involve me flying around Australia, seeing all my clients. I can now do it on Zoom. And so if I'm paying, an extra couple of $1,000s for a Zoom subscription, I'm saving myself all this travel expense. And so what software is doing is effectively taking share away from a physical industry. It's exactly the same if you think about Salesforce.com. So Salesforce.com, for those of us who are in Melbourne and read the papers, would know that the reason why Melbourne's contacting tracing doesn't work versus Sydney's is because they didn't install the Salesforce technology. The Salesforce technology is a marketing tool that ultimately the Sydney and other states did install, and for various reasons I'm not quite sure, that they chose not to here. And hence the comments about post-it notes, etc. And so if you're trying to track a sales lead or a virus lead, it's no different than the tracking a sales lead, and that's where Salesforce comes in. And so, this is really where Microsoft and ServiceNow, Adobe, and companies like Zoom, they essentially peer out of thin air. That's the exciting area today. As we go beyond that, there's all these peer-to-peer businesses that are popping up. And then finally, we're sort of moving into artificial intelligence. So this is when you think about things like Snowflake, or really the high-end semiconductors in ASML and TSMC. That's sort of the next phase. And so what we've done, the companies that we really like here are things like NVIDIA, that effectively, is what drives your Google Voice or your Alexa voice. And we've really looked at this like, these companies eventually at the end here become the weapons manufacturers. And so to give you an example, when NVIDIA releases this latest chip, which is the A100, which came out this year, there is a long queue of people who want it. And the reason why they want it, because they know if they get it first, that is their competitive advantage. And so the first people to get it are the hyperscalers, the cloud companies being Amazon, Google, and Microsoft, and Alibaba. And then they get it first, and then everyone slowly down gets that. So just be very clear that as we get further down this technology expansion, it ultimately becomes an arms race. And so just to show you here, this is what the R&D of these companies is, of the big five guys. It's an arms race to try and get faster and faster speeds. And so we want to buy the weapons manufacturers in that arms race. And that's where NVIDIA, ASML, and TSMC come in. These guys are spending aggressively, which ultimately grows their sales. And that ultimately allows them to disrupt these other companies. And the last thing I'd say here is the reason why we continue to look at these things is because disruption's clearly going to accelerate here. Companies have to spend to win. And we would just caution investors who look at income or they look at dividends and think they're sustainable. Because in many cases, these dividends or these buybacks, these companies outside of Apple here, they're effectively shareholder friendlying their way into not existing in the future. And it's important to remember that most companies eventually go broke. And as disruption accelerates, we worry more and more about these companies that aren't investing than we do about the ones that are. And those are the new areas that we're going to go to are AI, 5G, artificial intelligence, but ultimately the easy way to play it is just to own the weapons manufacturers, which is what we do with semiconductors and connectivity.
Oh, thank you so much, Nick.
Sorry, that was the long answer.
No, I actually think we're good now. I've got a couple of questions for David, but thank you so much for joining us. Really appreciated hearing from you. Can you hear me okay, David?
There you go. Now I can hear you fine, James.
Yep. Great. Sorry, just a couple of questions for you, which are more on the asset allocation side of things. Got one here. Your views on the possibility of a third wave of COVID next year, probabilities of that, and what issues that might cause if that comes to pass?
Look, I think you've got to, as I was sort of saying in the preso, I think we've got to distinguish a little bit between cases and ultimately deaths and hospitalisation rates, because I think it's one thing to have a surge in cases, but if you don't get the pressure on, I mean, the whole point of that lockdowns, initially was not to avoid getting COVID, it was just to avoid overrunning the hospital system. Now that's evolved in some areas, you know, and I won't get into a debate about Melbourne, but some of it is like almost an elimination strategy now. But initially it was about not overrunning our hospital systems, and I think that's the way many countries are going now. So I wouldn't worry, even if you get a third wave, provided it's a wave, you know, it's among, you know, younger, healthier parts of the population that basically, for many, you know, 99.9% of them will survive. It's not going to shut down the economy. So what ultimately matters is not the waves, it's the government reactions to those waves. And if you're not getting the pressure on the hospital system or the death rates, and they don't have to go into lockdown, then we can, you know, learn to live with the virus, as I think the term is being used at the moment. But so I think, you know, I'm you know, you never say never, but I mean, I think there's very good. I mean, if we get a vaccine, that immediately negates the risk of waves, because we'll be, you know, more immune to it. But I think even if we don't have a vaccine available, what we're seeing is that with waves, we're learning more about the virus, the contact, and again, maybe if Victoria can get its contact and tracing system up to speed within the next few months, even it can learn to live with the virus next time around. So I think that's the way I'm looking at it. It's not the case per se, it's hopefully the vaccine, but also that we can sort of live with those waves as they come through.
Thank you. Just two more questions. One is on gold in portfolio construction. Do you guys use it, and what do you think of the prospects for gold?
Yeah, look, we do have a couple of gold exposures, like a gold bullion ETF and a global gold miners ETF, and so we do look at gold. I look at gold closely, and you know, now some of our models we've had gold in the last few quarters. It's served us pretty well. Bottom line, I'm not super bullish on gold in the long run. I mean, gold's key advantage is that it has a low correlation with the equity market. So it is a good source of diversification in your portfolio. And if we do get a big breakout in inflation, people are looking at like central bank, you know, quantitative easing as potentially causing inflation. I don't ultimately see that as causing inflation the same way as it did coming out of the GFC. But gold can do well in an environment where interest rates are so incredibly low. And so, you know, many government bonds around the world now are trading at negative interest rates. So it's a fact. So I see it as holding up and potentially doing well if we get more quantitative easing by central banks on that yield story. Low interest rates, negative interest rates, the opportunity cost of holding gold as another defensive asset in your portfolio is reduced, and so that's why I see it doing well. But I'm not super long run bullish on it, because I don't see inflation breaking out. Others may disagree, but I mean, I still believe inflation globally, for many of the reasons Nick talked about, the technology disruption going on, is going to stay lower for longer going forward.
Thank you. And the last one, I'm probably going to paraphrase the question a little bit, but I took it as this growth investing in US tech businesses sounds fantastic, but there's no bloody income and we need it. So how do we build a portfolio and still have some income, but get some growth exposure?
Well, I guess a couple of answers. Firstly, I mean, you can invest in growth companies and sell a little bit of them over time, you know, chip away. I mean, if they're delivering, you know, if Nick can deliver 10% capital growth a year, and, you know, you can sell down a bit of your equity growth exposure and use that as your income. So that's, you know, one way people are doing it. But I guess ultimately, in the more defensive parts of the portfolio, I mean, there is a massive trade-off now. The higher yielding parts of the equity market, typically financials, infrastructure, they've been really hard hit by COVID. Now those infrastructure, I think, you know, they're not going to give it, I think the infrastructure that's been hit hard because of COVID, you know, the people not driving, not using the airports. So what ordinarily is a defensive yield play in your portfolio, even in equity downturns, have been hit hard because of the nature of this shock. But they will come back as economies come back, and they'll still offer, you know, a defensive source of income in your portfolio toll roads, airports, those sort of things, will still be driving and travelling. Now, they may not give you the growth that you'll get from some of the tech companies, but that's a trade-off you get within the equity market. The other point I mentioned, within your defensive portfolio, you do need to be a bit more creative. Term deposits, certainly cash in the bank are giving you, horrible yields. Even government bond yields are very, very low. So things like hybrids, things like longer duration bonds, corporate bonds, good investment grade corporate bonds, they can give you a bit of a yield pickup over and above cash. So thinking a little bit outside of the square on the defensive portfolio in this environment is something worth thinking about as well.
Thank you very much, David. And I don't think we've got any more questions. So I think we can probably leave it there for one day. So thank you everybody so much for joining us today. We really appreciate it. And thank you, Nick and David, for giving us your time. We know it's in high demand, so we appreciate it. To the clients, if you've got any further questions or would like some feedback on anything that we've spoken about, or think your portfolio needs to be tweaked at all, please get in contact with us or your advisor, and we'll get on the Zoom and make sure we're comfortable, we're positioned right. But thank you so much.
Okay, bye for now.